Sound Planning Group CEO. David, great to have you here with us. Just want to get your reaction to the numbers here and what this ultimately means for how the markets are going to best anticipate the Fed's next move.
Well, Brad, as we look at the numbers here this morning, nothing surprised the market. So I think it's just business as usual. I don't think the numbers really, the market's really been caring about CPI, previous to this moment. And with all these new tailwinds coming into the new year and this new presidency, I don't really see CPI knocking that off the track. But I will say this: I am personally very cautious about inflation, and I think that inflation is absolutely here right now in the United States. I mean, when we have a print of 3%, and we've been in the 3% now since 2022, we're not going down. And in fact, we're looking at everything at all-time highs right now. And the market's looking pretty strong. And so that's actually a very inflationary environment because things are just going to continue to grow right now. So I think that could be a big surprise for the market here this next year. But as it sets right now, I think it's business as usual as we kind of finish out the rest of the year.
Yeah, it seems like, especially within the shelter component, that's the part of the mix that there really is so much uncertainty around when that will start to abate. That removed, looking across some of the other indexes, I wonder where you're also kind of seeing a correlation or pass through to how companies are navigating their own communication with customers, knowing that customers might be paying a little bit more in this interim period of time, but even amid this, there is some disinflation still on the table.
There is some disinflation, but if we look at the year over year numbers, we're obviously trending still higher. And obviously there's a difference between cumulative inflation, like the difference of what we used to pay prior to COVID and what we pay today. And then now we're talking the rate of change from this moment forward. The year over year going back to 2020 is that everything costs 26% more. So I think the lower end consumer, the middle class, is very squeezed right now, and I'm very concerned about that because we're looking at credit card interest rates going up, faster than the savings rate. And obviously that spells disaster when you understand, 20-30%, on credit cards. I don't think anyone's doing that, because they think it was a really good way of, navigating this. But here's the reality: the consumer is strong and resilient. I do think, though, that as we see some of these supply side economic components come back in, that we will see some relief. But there's ultimately inflation in our system that's not abating, because when you friendshore, reshore, bring things back to the United States, that's more expensive than doing it at a place where you pay a much lower wage. So there are components to restructuring that have costs to it as well. So I don't think that there's an easy answer, but we're certainly look like we've got the right team in place to be moving forward ahead here and navigating that.
So what's the portfolio play? Because as you were mentioning earlier, inflation could still be very well around in 2025, and you still have a Fed that's going to have a target, at least at this point, of trying to get it down to 2%. Now, that's their target. The reality of where it may actually linger is probably, a couple basis points above 2% here reasonably. Right. So how does that pass through to the portfolio strategy?
Okay, so I think that we're going to be higher for longer. My base case is that unemployment is going to start falling apart. My base case is that inflation is going to go higher. So what do you look for when we have an inflationary environment? Well, stocks can be a great answer. Most people are already allocated to that, so I'm not going to waste your time. What I'm going to do is give you an idea that's not already in 60-40 allocations. Gold, silver, Bitcoin. You can buy things physically in the gold, silver space, or you can do the miners. The miners are on sale right now, and if you look at the price that they pay in the ground for silver or gold, you're getting a discount. So that's a pretty awesome opportunity to be looking at. But gold has ultimately, beat the indexes here over the last 12 months. It's up 35%, but silver's up 39%. Here's my reasoning for silver, okay? And that is, if you look at the gold standard, a 15-to-1 ratio was how much silver we could mine to gold. It's currently 9-to-1 is the mining ratio. But if you look at the rate of exchange right now at $32 silver, 2,700 gold, you're at 84 ounces of silver to 1 ounce of gold. I'll do that deal every day of my life. And then the last one is Bitcoin. Now, finally, crypto got a pro, crypto president in Congress, and we've got all these new conversations that are happening right now. I do not believe that people recognize how scarce specifically Bitcoin is. 94% of it has been mined. We still have nearly 110 years left of mining ahead of us for the last 1 million coins. I don't think that computes to most people. It is a scarce idea by design. It continues to half and become less and less and less and more scarce as time goes along. So I think people are going to really be looking at those options as alternatives, diversifiers that can also provide some alpha here. Whether the economy goes well or doesn't go as well, I think we need all three of those.
David, thanks for taking the time here with us this morning. Appreciate it.
Pleasure's mine. Thank you, Brad.